inflation is a big problem, and it affects everybody disproportionately so.
In the U.S. is now at 6.5% higher in December compared to a year ago. So what does that mean?
Pretty much unprecedented. We haven't seen them like this in years. We haven't seen them before at all, actually.
For well over a year, inflation has slowly robbed many American households, soaking up their hard-earned savings. The Federal Reserve, in a battle to tame inflation, has raised interest rates 7 times in 2022 and has indicated that it will enact additional rate increases in 2023. The hope, of course, is that the Fed's moves will result in a so-called soft landing, meaning the economy slows enough that consumer prices come down without dipping into a recession. The latest data suggests that higher interest rates are finally putting a dent in inflation after it had accelerated 9.1% last June, its fastest pace in 4 decades. In December, U.S. Consumer Price Index showed that annualized inflation has slowed down to 6.5%, marking the 6th straight month that the pace had slowed. But it's still a long way down to the Fed's goal for an inflation rate of 2%. Fed Chair Jerome Powell himself has acknowledged that some economic pain could be coming as a result of the central bank's measures to bring inflation back to its target. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions, Powell said. Despite recession fears, the Fed is also concerned about raising interest rates too slowly. When facing high inflation, policymakers fear what's referred to as a price-wage spiral, in which a rise in prices prompts workers to demand raises that help them afford goods, which in turn pushes up prices, leading to a self-perpetuating cycle of runaway inflation that can be difficult to reverse. Despite all this, evidence in favor of a soft landing for the U.S. economy, in which inflation declines without major job losses, appears to be growing. Inflation has been declining over the past several months against a backdrop of moderate growth, Federal Reserve Vice Chair Lael Brainard said in prepared remarks for a speech that noted a significant weakening in the manufacturing sector, a moderation in consumer spending, and other data pointing to now subdued growth in 2023. In addition, she said the full impact of last year's aggressive Fed interest rate increases has yet to be felt. The U.S. Central Bank raised its benchmark overnight interest rate by 4.25 percentage points in 2022 to the current 4.25% to 4.50% range to fight inflation that climbed to 40-year highs. At the same time, Brainard pointed to trends in prices, wages, and margins that indicated inflation, which by the Fed's preferred measure is running at almost 3 times its 2% target, was slowing and could well continue doing so. The U.S. unemployment rate, meanwhile, is at a low 3.5%. It remains possible that a continued moderation in aggregate demand could facilitate continued easing in the labor market and reduction in inflation without a significant loss of employment, Brainard said. The Producer Price Index, PPI, which is used as a gauge of inflation pressures on businesses, came in below Wall Street's expectations this week, declining 0.5% month-over-month. The Bureau of Labor Statistics reported year-over-year measure of producers' price was still up 6.2% last month, but that's the lowest level since March 2021. U.S. employment continued to show modest to moderate growth over the past few months, according to the U.S. Federal Reserve's Beige Book report released Wednesday. Some Federal Reserve districts reported labor availability had increased, but firms still experienced difficulty recruiting. The report also noted some companies hesitated to lay off employees even as demand for goods and services eased. Overall, economic activity was relatively unchanged since December. Slowdown in demand from consumers seen in the retail sales data, along with fading producer inflation, is the positive sign that the Fed's policies are effectively taming inflation. Slowing inflation along with tight labor market makes the case for soft landing more likely. Thanks for watching and consider subscribing.